Hello, let us look at how we prepare the statement of profit or loss given the trial balance. And here today we have an example where we have been given the trial balance of KM Supplies Limited as at 31st December 2025. And also we've been provided some additional information and we've been asked to prepare the statement of profit or loss for the period ended 31st December 2025. Okay, so recall the structure of the statement of profit or loss. Remember to indicate the name of the company that we are preparing the statement and also indicate the period that we are looking at. Okay, so let's jump right in. The first aspect is revenue, and when we look at our trial balance, we have sales revenue with an accumulated amount of 600,000. So we should come and indicate our revenues during the period was 600,000. Then the second thing is the cost of sales. When you look at our trial balance, you're going to see that we don't have any cost of sales during cost of sale account. This is because this company is using a periodic system, inventory system. When you are using the periodic inventory system, you calculate your inventory balances and the cost of sales balance as at the year end. But when you are using the perpetual inventory system, at every specific point when you're transacting, you make sure you have you've added or subtracted to your cost of sale or inventory as the transactions happen. Okay, so now we have to calculate the cost of sales by ourselves, which is usually the opening inventory, that is the closing balance of the prior period, that is the inventory that was left in the previous period, then plus the purchases that you have bought during the period, minus the carriage, plus the carriage inwards. The carriage inwards is the cost of bringing these purchases from the supplier to your warehouse, for example. So it is a cost that is added to the purchases. Then minus the closing inventory. This is the balance of the inventory that you have as at that year end. Okay, so to calculate the cost of sales, it's basically looking at the opening inventory where we have the inventory brought forward as 70,000. Inventory brought forward is basically inventory brought forward from the previous period. So it is the closing balance of the previous period and the opening balance of our current period. Okay, so we have 70,000. We come say 70,000 plus purchases. We have purchases amounting to 320,000. So 320,000 plus carriage inwards. We have carriage inwards of 12,000. Okay, 12,000. Then we have closing inventory. We have been given in our additional information that the closing inventory as at 31st December 2025 was 90,000. So we need to deduct that because this is what is left at the end of the year. So meaning it has not been sold. So when we calculate this, you're going to get 70,000 plus 320,000 plus 12 minus 90,000. We are going to get 312,000. Okay, so we can indicate that in our statement. Cost of sales is 320,000. Remember, this is a net expense, so it is a negative value. So to calculate gross profit is basically going to be 600,000 minus 312,000, which is going to give us 288,000. Okay, so we can indicate here 288,000 as our gross profit so far. Now next, let us look at the administrative expenses. Administrative expenses, you can see from our TB, we have accumulated costs of rent expense, salaries expense, utilities expense, insurance, and office expenses. Okay, so when we look at that, we have first to sum the rent expense, the salaries, and utilities, insurance, and office, which will give us a total of 178,000. Okay, but one thing you should not forget, given from our additional information, we are given the depreciation for the year is equipment is 10% straight line method, and motor vehicle 20% reducing balance. Okay, so when you look at your TB, you have there is something you have here. You have an account with accumulated depreciation for equipment and accumulated depreciation for motor vehicle. We have a balance of 60,000 and 30,000. Remember, this is basically accumulated depreciation from the prior periods, okay? So this one usually reduces the account for motor vehicle and the other one for equipment, okay? So this is depreciation that has been calculated in the prior period. So you need to be able to calculate the depreciation that will be affected on these assets during the period that we are reviewing, because remember, we need to recognize depreciation of depreciation expense of assets during the period that these assets have been used to generate revenue, okay? So the depreciation during the period, first, let's start with for equipment. We are told for equipment, it is a 10%, right? Yeah. We have 10% straight line. So this means basically all the periods we are expensing the same amount of depreciation. So it will be 10% of the cost of assets. And the cost of assets, you can see here, equipment, we have a cost of 250,000, okay? So it is 250 multiplied by 250,000, where we are going to have a 25,000 as a depreciation expense for equipment during the period. Now let us look at motor vehicle. For motor vehicle, we will have, we are told 20% reduce in balance. Remember, for the motor vehicle, you have to, the depreciation cost is on the net book value of that asset, not the original cost of that asset. And you can see the original cost of motor vehicle is 150,000, okay? And during the prior periods, there is an accumulated depreciation on motor vehicle of amount 30,000. So you need first to get the net book value, which is 150,000. That is the initial cost of the asset minus the accumulated depreciation, which is 30,000, okay, which will be 120,000. Then you multiply it by now 20%, okay, which is going to give us 24,000. So you should be not to add that we have a 25,000 and 24,000 expenses, which is a depreciation expense. So we need to add here 24,000 and also add 25,000, and we're going to have a total of 227,000, okay? These are operation costs. These are operation costs, or rather the administrative costs. You can see these are costs that a company incurs in the process of managing the business, like rent, salaries, okay? So even depreciation cost is an operating expense. So we are going to have 227,000. Remember, this is a negative value, okay? So 288,000 minus 227,000 is going to give us 61,000. So our operating profit will be 61,000. Okay, now let us move on to the next, investment income. In part of our additional information, we have been told the company received dividends of Kenyan shillings 8,000. That is from ownership of shares. So the company has some shares in another company, and this is the dividends they have earned during that period, or that ending 31st December 2025. So we need to include that. We are going to look at how this affects the balance sheet as well in the next video. So here we have 8,000 as our investment income. Remember, this is income, so it is a positive value. Now let us look at the finance cost. The finance cost is the cost of borrowing. It is the cost of having a loan, and you can see from our trial balance we have actually a loan. A loan payable indicates we have a loan. So we are told the loan interest for during the period is Kenyan shillings 25,000. So the loan period, that when you look at the contract of that, the loan terms, you're supposed to pay 25,000 of interest during that year. So you need to make sure it is indicated whether you have paid it or not, because remember, it's something you ought to pay depending on your terms. Okay, so also these we're going to look at how it affects the balance sheet, that is the statement of financial position. So we have a cost of 25,000, that is the cost of borrowing. Okay, so we are going to have the operating profit plus the investment income minus the finance cost, which is going to give us, sorry, I think we have this should be 20,000. Yeah, 20,000. So our profit before tax will be 49,000. That is 61 plus 8,000 minus 20,000, which will be 49,000. Okay, so what is our corporation tax? In part of our additional information, we've been given the corporation tax of 25,000. So that also indicate 25,000. And the profit for the year will be 49,000 minus 25,000, which will be 24,000. Okay, so basically that's how we prepare the statement of profit or loss. If we had some gain, unrealized gains and everything, now we could have a section of comprehensive income. But in our case, we don't have any that requires us to have comprehensive income. So stick around, because with the same question we are going to look at now, the balance sheet for this year, same question.